The global developments that the Fed is monitoring, how much of a risk for the American expansion would be the prospect of a hard Brexit?
So we've been monitoring the Brexit situation very carefully for a long time, and for us that starts with U.S. financial institutions that have a presence either in the UK or in the EU or both. So we have worked with those institutions alongside UK and EU regulators to assure ourselves that those firms have plans and have liquidity and have all the things they will need to deal with the full range of Brexit outcomes. So we've done a lot of work on that, and generally speaking, again, a lot of work has been done. You have to be humble and say that this is an unprecedented event. So that's the financial system aspect of it. If there is a hard Brexit, then that would very likely involve disruptions both to the continental economy and certainly to the UK economy, and we would feel that. The question would, for us, it wouldn't be a huge first order thing, the economic effects, unless you saw financial disruption. So if you saw financial turmoil and that kind of thing, that would be the way it would reach us. I would expect that we would feel some of this, and it's very hard to have great confidence that you know what that would be, but it would be something, probably not material to our economy, but it's something we'll be watching very carefully, and certainly hoping that there is a resolution short of a hard Brexit.
Jean Young with Market News. I have a question about the ultimate size of the balance sheet. How will the Fed judge what is a reasonable level for financial institutions' demand for reserves when it appears to be rising at a fast pace over the past year, and perhaps at a faster pace than can be explained by regulatory changes during that same time frame? Would you prefer to err on the side of being more generous, or would you try to encourage banks from to hold less reserves?
Let me be clear. I don't know that demand for reserves has risen over the past years. I think our understanding of demand for reserves. Remember that the banks have more reserves than they need. Reserves are still quite abundant. So the question is how much of that amount is actually going to be needed in the end after the firms adjust to our very gradual decrease. And so our understanding really of the distribution of reserves and how much will be needed has moved up over the past year. And then there would be a buffer on top of that, and then we would want to be we want to have a buffer, as I mentioned in my remarks, because we want to be operating in an abundant reserves regime where we operate through our administered rates. If you operate too close to that point of scarcity, then you wind up having to have these big ongoing interventions in the market. We don't want the Fed to have a large ongoing presence in the market around this. We'd rather just, in managing the federal funds rate, we'd rather have it set by our administered rates. So that implies you'd want to be a bit above what that equilibrium demand for reserves is. And again, there's no cookbook here. There's no playbook. No one really knows. The only way you can figure it out is by surveying people and market intelligence, and then ultimately by approaching that point quite carefully.